Hello everyone, I am Michael Ruger. I am the managing partner of Greenbush Financial Group. The topic we're going to be covering today is if you or your spouse are covered by a 401k plan, are you allowed to contribute to an IRA in that same tax year? And the answer is it depends. It depends on a number of items, which include, do you plan to contribute to a Roth IRA or a traditional IRA? What is your income level? Do you plan to take a tax deduction for those contributions? Is it you or is it your spouse that's covered by the 401k plan? And in addition to these items, we're also going to go over if you have to choose between either contributing to a 401k or an IRA, which one might be the better one to go with. But if you have the luxury of having enough income to say, hey, I can max out my 401k and also contribute to an IRA, we're going to talk about some tax strategies behind that and also spousal contributions. Let's start off by talking about traditional IRAs. So traditional IRAs are the ones that you make contributions to, you get a tax deduction for it, it accumulates tax deferred, and then when you take it out of retirement, that's when you pay tax on it. So for 2022, the contribution limits are if you're under the age of 50, it's $6,000 for a given tax year. If you're 50 or older, you could put in $7,000. Now, whether or not you can take it to tax deduction, if you or your spouse are covered by a 401k plan, there's income thresholds. Let's say if you're over the thresholds, you can no longer take a deduction. Here's a chart showing where those income thresholds are. So if you are the one that's covered by the 401k plan and you file married filing joint, the ability to deduct a traditional IRA contribution begins to phase out at $109,000 per year, and then it fully phases out at $129,000 per year. So if you're below that bottom threshold, you can fully deduct a traditional IRA contribution and contribute to a 401k plan. If you're above that threshold of 129, now you can no longer deduct any of your traditional IRA contribution. If you're in between, there's that phase out amount that takes place. If you're a single filer or head of household, the range is $68,000 to $78,000, and married filing separately is $0 to $10,000. The second table is if your spouse is covered by a 401k plan, but you are not, the income thresholds are different. So in that scenario, married filing joint, as long as your modified AGI is below 204,000, you can actually deduct a contribution to your traditional IRA account. Once you get up above 214,000, that's where it fully phases out, and you can see the thresholds for married filing separately. Whether or not you can take a deduction for those traditional IRAs does not preclude you from still making what's called an after-tax contribution. So if you're fully phased out of the deduction, you may still be able to make a $6,000 contribution to a traditional IRA. You don't get a tax deduction, but you still get to take advantage of the tax-free accumulation that the IRA offers. So I make a $6,000 after-tax contribution to my traditional IRA, don't get a tax deduction, it gets to accumulate tax-free, and then when I retire and pull the money out, I have to pay ordinary income tax on the earnings. Now, there's two reasons why we typically see investors go this route. The one is they are executing what's called a Roth backdoor contribution strategy, which I'll put a link to that video below because it's just a backdoor way for people to make Roth IRA contributions. The second is they're just trying to take advantage of the tax-free accumulation aspect of the IRA. So if I have, let's say, a stock that's producing dividends and it's held in a brokerage account, I may have to pay tax on those dividends, or if I buy or sell it, I have to pay tax on the capital gains. Or if I'm holding that in an IRA, those dividends I don't have to pay tax on now. And if I buy and sell stuff, the capital gains are insulated by the IRA account. It's kind of that tax deferred savings vehicle. The downside of that strategy is when I get to retirement and I pull all those gains out, I'll have to pay ordinary income tax on those gains versus if the appreciation happened in a brokerage account, I may be able to get those gains at long-term capital gains treatment. Okay, we just covered all the traditional IRA stuff. Now let's shift over to Roth IRA. So Roth IRAs are the ones where you make after-tax contributions, it accumulates, and then when you pull it out in retirement, it's all essentially tax-free. That's a Roth IRA. So the question becomes, if you or a spouse are covered by a 401k plan, you want to contribute to a Roth IRA, can you? The income rules are different, and they're actually more simple because it's not like am I covered, is my spouse covered, what are the phase out ranges? The Roth income limits are very straightforward because it's the same for everyone. For 2022, here are the income thresholds to be able to make a Roth contribution. So if you are married filing joint, the phase out range is between $204,000 and $214,000 of modified AGI. So if you make below $204,000, you are eligible to contribute the full amount to a Roth IRA. Then that begins to phase out. And then once you're over 214, you're no longer eligible to make a Roth IRA contribution for that tax year. The next line is for single, head of household, or married filing separately, and you live apart from your spouse. That phase out threshold is $129,000, $144,000. And then the final is married filing separately and you live with your spouse. That is 0 to 10,000 phase out threshold. A quick note before we go on, IRA contribution limits are aggregate for the year. So that means if you do $6,000 to a traditional IRA, you can then not turn around and do $6,000 to a Roth IRA. That's $6,000 or $7,000 threshold is the total limit for all IRA contributions in a given calendar year. If your income level allows you to contribute to either your employer's 401k or an IRA, which one should you go with? And there's a number of factors that come into play. The first one is, does your employer offer some type of employer matching contribution? Any type of retirement plans where they offer a match, meaning you have to put money in the plan to get their matching contribution, we usually encourage plan participants to do that because otherwise you're just leaving free money on the table. The next question is, does your retirement plan allow you to make Roth contributions? If you're at an age or a tax bracket where it makes sense to be making Roth contributions instead of pre-tax contributions, not all retirement plans allow Roth deferrals into those plans. So you might get stuck with a decision. Now, if they have an employer match, it may still make sense to do pre-tax contributions just to capture the match. But over and above that, if you really should be doing Roth, that might lead you to say, hey, I'll do the pre-tax contribution in the 401k up to the match, but then from that point forward, I'll do Roth contributions to my IRA. Fees will also come into play because you really have to do a comparison of what you're paying in the 401k plan versus what you'd be paying in an IRA. Because if you have a $20,000 balance in the 401k plan, but that 401k plan has, let's say, $10 million in assets, that's normally being feed like a $10 million account versus if you take your $20,000 and put it in a $20,000 IRA, that may have higher fees because it's feed like a $20,000 account. You don't have that global advantage of the 401k assets. Also, 401ks may give you access to lower cost mutual funds. You might have access to institutional share classes, which you wouldn't over in the individual IRA side, so you just have to factor those pieces in. When it comes to investment options, IRAs can offer more flexibility than 401ks because with the IRAs, it's your own account. You can invest in pretty much whatever you want. Within 401ks, a lot of 401ks have a set menu of mutual funds, and if you don't like that set menu of mutual funds, you might not have any other choice. So people might go to an IRA to say, I want more control flexibility. Some 401k plans will allow self-directed brokerage options, but not all. After factoring all those things in, I'm a big fan of easier is better. If it's a close call and you're contributing to a 401k plan, it's a lot easier having all of your retirement assets in one spot and managing one account versus having a 401k here, a Roth IRA there, traditional IRA over there. Like, it's usually better to have everything in one place. Now let's look at a double max out scenario. So if you have the income that you're able to max out both a 401k and an IRA, the strategy really comes down to your income thresholds. So let's say you're 51, you are covered by a 401k plan, and you're filing a tax return married filing joint. So in that scenario, you can put $27,000 in your 401k, and you may have the option of contributing $7,000 to either a traditional IRA or a Roth IRA. Now at $180,000 modified AGI, you are not able to deduct that $7,000 to your traditional IRA, but you can make an after-tax contribution. But because you're below the income threshold for a Roth, you can actually put the full $7,000 into a Roth IRA, after-tax accumulation, and pull that money out down the road, all tax-free. Now, an advanced tax strategy is this. While you are covered by the 401k plan, your spouse, if they are not covered by a 401k plan, they fall under those different income thresholds for the traditional IRAs would say, you might be able to make a spousal contribution to a traditional IRA, take a deduction for that $7,000 for your spouse, and then get that tax advantage. I hope this was helpful. If you have any questions, please feel free to reach out to me at moneysmartboard.com. Thank you.